seem to care. Well, nobody love me, babe. Nobody seem to care.
Well, good morning, everyone. It's a pleasure to be here today. I actually live in Singapore, where it's 33 degrees and sunny, so being in London in December is a rare treat for me. Now, I was asked to speak about gold from an investment standpoint, and simply put, the headline on the screen here just about covers it. Gold apparently is, and I quote, the worst investment in history. Now, that, of course, makes it a worse investment than the South Sea bubble. It means you'd have gotten a better return putting your money in Enron, or so it would appear, or for that matter, WorldCom, or even government bonds in the early 1800s when 1 in 3 issues went into default. Hell, gold is even a worse investment than Mario Balotelli, for God's sake. Yes, gold, we are reliably informed, is the worst investment in history, a headline which was written in February of this year by a gentleman by the name of Brian Lund. Now, I almost hate to break it to him, but gold isn't even the worst investment since he wrote that article. However, neither commodities, nor emerging market equities, nor even an asset class which actually has the word junk in its name elicit the kind of hatred that a supposedly precious metal does amongst the broader investment community. It's hard to understand how one could reach the conclusion that Mr. Lund did if we look at this chart, which goes all the way back to 1791, though I will concede that if you'd bought gold here, it was most definitely a bad investment, though one could even argue that during the depths of the bear market, the 20-year bear market in the 80s and 90s, there were chances to make sizable returns from buying gold. But no matter. Mr. Lund's withering assessment of gold was largely based around 2 pieces of evidence. The first was taken from Jeremy Siegel's book, Stocks for the Long Run, in which the author compared the returns from stocks, bonds, T-bills and gold between 1802 and 2006. Now, what he found was that gold supposedly earned a return of 95% during that time, which, in comparison, is a terrible payback against all the other alternatives. We'll put the idea of a 204-year-long buy and hold trade aside for now. And whilst I'm about as inclined to question Jeremy Siegel's mathematical prowess as I would be that of Bugsy Siegel, there's a crucial point missing in that over the life of a traditional portfolio, for every $1 foolishly invested in such a stupid asset as gold, there would be a minimum of maybe $9 invested in stocks and another $10 or so sitting in a blend of bonds and T-bills. So if gold didn't carry its weight as an investment, it wouldn't really have mattered. It would, however, have provided insurance against periods of volatility. The second reason Mr. Lund gave is far more disturbing. He cited the prevalence of less than reputable salespeople in the precious metal space. Now, I've made a note here to pause and wait for the sound of people shifting uncomfortably in their seats to die down before proceeding. Everybody comfortable? Good. I mean, it's not as though you find any less than reputable salespeople in other parts of the financial industry, thankfully. Now, as everybody in this room knows, there are 3 emotions, and only 3, that gold stirs: love, loathing, and complete indifference. Now, at the right point in the cycle, gold is something everybody wants to own, or at least believes they want to own. The distinction is actually an important one. While at the other end of that pendulum's arc is a place I like to call today, a point in time where using the word gold evokes a similar reaction to that which one gets when using the word Amway. That's just where we are in the cycle. It's really not too much more complicated than that. But for the gold lovers, it feels like purgatory. For the haters, nirvana, while the vast majority of the rest of the world neither know nor care what's happening in the gold market. We all know that there are certain things in this life that are universally unloved. Take the selfie, for example, something which is at least, I'm fairly certain, unloved by people of my vintage, if not those of a rather younger demographic. Or mosquitoes. Now, when was the last time you had anybody tell you that they were actually lovable but misunderstood creatures who deserved a better deal? And then, of course, there's gold.
Born to lose, I've lived my life in vain. Every dream has only brought me pain. All my life I've always been so blue. Born to lose, and now I'm losing you.
Yes, in the last 4 years, gold, and particularly the mining stocks, have been extremely generous to investors. Now, anybody who missed out on the chance of losing 40% of their capital in GDX was given another opportunity, this time to lose 60%. Then another chance to lose 40%, and most recently a chance to toss away a further 37%. In the juniors it was even worse. Those numbers were 71%, 52% and 36% in a 4-year period. That's quite something. But as my friend Rick Rule sagely points out, it's precisely this despair, this capitulation, which is absolutely crucial for bear markets to end and bull markets to begin. The question of whether we've reached that capitulation point has been the one I'm asked most often as I've travelled around the world for the past several years talking about this stuff, and my answers remain fairly consistent throughout, and we'll come to that shortly. But first we need a little perspective. The GLD ETF is, in the Western Hemisphere at least, the most popular investment vehicle for the casual investor who thinks they want to own gold. The price of GLD, the yellow line, mirrors that of the gold price, which, as most of us know, far from being the price of gold itself, is actually the price of a piece of paper which is traded on the COMEX, but that's a different presentation for another day. It's the volume I want to focus on here, which is represented by the white bars. Now, as you can see, while the gold price was heading higher between 2004 and 2009, the volume followed suit as new investors got sucked in by the promise of higher prices. After a little bit of boredom set in when the prices kept going up, I know, it sounds ridiculous now, we got that run to 1900 in 2011 as the debt ceiling fiasco raised fears over a possible US default. And what do you know? We had a demand-driven volume spike to an all-time high exactly as the price peaked. Buying at the top, en masse, is exactly what those casual investors do, always. The second set of volume charts, as the price has reversed and fallen steadily for the last 4 years, speaks, well, volumes, funnily enough. The GDX ETF has seen 4 major periods of elevated volume, which correspond with separate periods of both despair and belief. Despair amongst many long-term holders that the stock prices of the larger gold miners were going to zero, and belief on the part of new entrants to the market who were speculating that nothing could be this unloved and that a turn in the market was both inevitable and imminent. One out of 2 ain't bad, I guess. The same chart of the GDXJ, the junior miners ETF, shows that after the first failed attempt to catch the falling knife in GDX, everybody felt that the second rally had to be the bottom, and that pulled more hot money into the juniors. After all, what better to own than junior mining stocks to take advantage of the additional upside gearing they'd give you amidst the inevitable takeover frenzy? I'll tell you what else, shall I? Virtually anything else, that's what. But despite its lack of the dramatic, it's the top chart that I think is the most important. The charts of GDX and GDXJ tell the story of the first 2 of our 3 emotions, loving and loathing. But the chart of GLD shows quite clearly the third, a growing indifference to the idea of casually owning gold amongst Western investors. How extreme has the apathy towards gold become? Well, here's a little experiment I conducted for the purposes of illustration. This chart shows the Google search frequency for the term gold mining stocks between 2004 and 2015. The chart's a relative one, so the highest volume of searches occurred at the spike you can see, which of course coincided with both the debt ceiling farce and $1,900 gold. What's also noticeable is the fact that the number of searches for the term gold mining stocks at $1,900 gold were 50% higher than at the height of the Great Recession. After the peak, interest has been in steady and fairly dramatic decline. Now, here are the results for a similar search over the same time frame for the term raw sewage. Searches for that particular phrase peaked in late 2005 for reasons I was unable to uncover, but it's noticeable that, once again, at the moment of $1,900 gold, and in fairness it has to be said, perhaps more relevantly, with antipathy towards US lawmakers climbing rapidly, we saw another peak in searches for raw sewage in August of 2011. Subsequently, searches for raw sewage slipped back to the consistent 10-year channel in which they tended to confine themselves. That's fairly much as one would suspect, and with each of these charts being relative to themselves rather than each other, it's hard to make any real comparison. Until, that is, we put the total volume of both searches side by side. At which point we discover that, perhaps unsurprisingly to many people watching this, raw sewage is almost scientifically proven to be 1.8 times more popular than gold mining stocks. What's more, I might add, is that over the period being measured, the gold price has both more than tripled and been cut almost in half. That, ladies and gentlemen, is a truly unloved asset. Google also very helpfully measures the geographical intensity of searches made for a particular term, and when we look at a map of such searches for gold mining stocks, we find something which, I guess, is hardly surprising at all. The intensity of searches for that term, gold mining stocks, is greatest in Canada, followed by the United States, South Africa and Australia. The rest of the world, nobody cares. Outside of a group lovingly referred to as gold bugs, the rest of the world is at best completely indifferent to gold and at worst hates it with the passion of 1,000 burning nuns. That rest of the world includes, I'm sad to say, the vast majority of the institutional investment community. The average pension fund allocation to both gold and gold equities is, according to research by Shane Maguire of Texas Teachers, just 0.15%. And with that number being an average, it gives us a sense as to just how many people have zero allocation to gold, something which should help explain the sheer number of people who just don't care about the yellow metal. Elsewhere, the retail component has also fallen out of love with owning gold, as total holdings of gold in ETF products, which have almost halved since early 2013, demonstrate clearly. Incidentally, holdings of silver in the various ETFs has remained disconcertingly stable. Now, there's something curious going on, and I think I may have managed to identify the root of the problem. In America, the science of studying metals is called metallurgy. See? Meanwhile, we Brits prefer a pronunciation we like to think is fittingly a little bit more refined.
Metallurgy.
Either way, metallurgy is a science many in this room have devoted their lives to study. It's consumed many from the earliest alchemists to the slightly less mystical proponents we find in today's world. But the problem facing the world today isn't one of metallurgy. No, it's one of metallurgy, of sorts. The metallurgy I'm referring to is the extreme negative physical reaction suffered involuntarily by many people upon any form of contact with precious metals. Symptoms can occur through direct contact with bullion or, in most cases, simply triggered by the mere mention of the word gold. By way of illustration, this is Sir Henry Bessemer. Sir Henry was a metallurgist, while this is my buddy Barry Ritholtz. Barry is a metallurgist. Cyril Smith, metallurgist. Ben Bernanke, metallurgist. You get the idea, I'm sure. But the problems of metallurgy notwithstanding, the performance of precious metals in recent years has been mystifying to say the least, as headline after headline, which ordinarily one would believe couldn't fail to be positive for the gold price, has come and gone without any upward pressure being applied. It's enough to make a grown man weep.
It brings a tear into my eyes when I begin to realize I cried so much since you've been gone. I guess
Yes, the list of positive catalysts for higher gold prices has been growing seemingly longer by the week, until now we've reached the point where the sovereign debt of several supposedly safe haven countries is being issued with negative coupons, and a small group of central banks have actually moved to negative nominal interest rates. This is what the end of the road looks like, folks. Take a good, hard look. What kind of world must we be living in when so-called investors are paying bankrupt governments for the privilege of lending them even more money that they can't pay back? Could there be an environment more conducive to higher gold prices? It's genuinely difficult to think of one. I certainly can't. Instead, as you can see from this timeline, where green represents news which ought to be positive for the gold price, despite many positive catalysts over the last 3 years, the gold price has just consistently continued to move lower. Why? Well, that's rather simple, really. Nobody cares. This strange reluctance of gold to do what those who watch it closely, looking for any sign of a rebound, expect it to do, has led to a wide array of supposed reasons why what is happening isn't what should be happening. Speculation is rife that the bull market is over, that central banks are in complete control, and there's no need for any kind of plan B on the part of investors. We have essentially zero inflation, and there are the usual theories about aggressive short selling by the bullion banks, as well as continued manipulation of the gold price by central banks, who are hell-bent on not allowing the gold price to highlight the level of debasement they've achieved with their various sovereign currencies. Now, many gold market watchers ascribe to a combination of all these theories, but the simple truth is this: nobody cares. Nobody cares because in the last 3 years they've seen the S&P 500 gain 45%. They've seen the Stocks 50 in Europe gain 35%. And most importantly perhaps, the US dollar has strengthened to the tune of 25% against its main competitors. And that is a massive move for any currency, let alone the world's reserve currency. Now, prior to mid-2014, when the current dollar bull market began in earnest, it had been stable for some considerable time. And when the currency used as the denominator in calculating what is generally accepted as the gold price is stable, well then, so is the gold price. So steady, in fact, that it ended 2014 down a mere 1.79%, which is hardly the sort of annual performance which would attract much attention from anyone who didn't already care about the price. 2014 also saw gold in Indian rupees, home of the world's savviest and most price-sensitive demand, gain a measly 1%, something which ensured that, relatively speaking at least, nobody in India really cared about the gold price during that period. However, here's where we get to the part where it turns out there are perhaps more people who care about the gold price than its performance would suggest. The people of Turkey, Brazil, Japan, the EU, Russia and the Ukraine all cared about the price of gold in 2014, thanks to the actions of their governments, who actively debased their respective currencies. Gold protected them significantly. And 2015 is a similar story, despite the notional 10% fall in the gold price in dollars. But in the USA, Canada, Australia and the UK, the need for gold as any kind of insurance policy has been deemed to be virtually non-existent. After all, everything's fine, there's nothing to worry about. Meanwhile, elsewhere, as we've seen, the citizens of other countries have been looking to gold to protect them from currency debasement, and in many cases, it's continued to be accumulated as a centuries-old trusted store of wealth. Over the last 6 months, the weakness in the Aussie dollar has meant we've seen a new addition to the ranks of those for whom gold is providing respite from currency woes. Now, a couple of weeks ago, the World Gold Council released their demand trends report for the third quarter of 2015, and against the backdrop of a plunging gold price, the figures contained in it were extraordinary. Consumer demand was strong, and surprisingly a strange name appeared on the list of conspicuous buyers, the United States, and its whereabouts on that list was positively shocking. Yes, demand for US gold soared 62% in the third quarter, something which potentially adds the US to our list of concerned citizens, and that, if it continues, is big news indeed. The commentary from the WGC was particularly interesting, with this passage sticking out like a sore thumb. This signalled both a level of interest in gold investment not seen since the global financial crisis and a level of price awareness on a par with that of Indian and Chinese retail investors. That is a big and very important change. And this is what that demand looks like in a chart. But there's another important group which has begun to care about gold in recent years, and that's central banks. Yes, the very same central banks who continue to peddle this story that we're in the midst of some kind of economic renaissance, and who, ironically, were the world's biggest sellers of gold, when that story they're peddling today was actually true back in the 80s and 90s. In fact, right up until 2009. These guys are now snapping up hundreds of tons of gold as though they didn't believe their own BS. Go figure. Whilst they're simultaneously dumping the world's supposedly safest asset at an unprecedented rate. Suffice to say, there's a rethink going on in official circles as to what constitutes a safe asset, and this little cabal just so happens to be the biggest and most price-insensitive group of buyers in the world. Elsewhere, traditional buyers of bullion continue to get wealthier, and as they do, they continue to convert a portion of that increasing wealth into physical gold. Now, this is not a trend which is going to reverse, certainly not in our lifetimes, probably not ever. This phenomenon is perhaps most clearly demonstrated by the weekly withdrawals of physical bullion on the Shanghai Gold Exchange, which have more than tripled since 2009, leading to one of the most perfect and most easily projected charts you're ever likely to find. Meanwhile, physical deliveries from the COMEX warehouses continue their decline as paper trading in the US overwhelms any interest in bullion. Now, this chart shows physical deliveries being made out of the Shanghai Gold Exchange. And here are the physical deliveries on the COMEX that you saw in the previous chart to scale. Shanghai now delivers 52 times the physical gold sold in New York. And still people talk about the gold price being a COMEX contract. For those of you who still believe the price is set in New York, everybody taking physical delivery in Shanghai thanks you for your assistance. By way of illustration of the difference between Chinese investors and their counterparts in the West, at least where gold is concerned, here's a similar experiment using internet searches. This line represents the gold price in renminbi per gram between July and October of this year. As you can see, the price began and ended the period at roughly 235 renminbi per gram, with little fluctuation in between, except for the swoon in August. Now, that dip is about 15 renminbi per gram, or $2. Now, look what happens to searches for the words gold jewellery on Taobao, which is China's equivalent of Google, when the price of the metal suddenly drops just $2. They triple. A $2 per gram drop in price. The Chinese care. So what, I wonder, would happen if a few other people started to care? Other people like our friends the pension funds who, as we've seen, have a minimal exposure to gold and gold equities. What if they doubled their allocation to just 0.3%? Well, that would mean an influx of over $100 billion looking for a home within the gold universe. And as most of you know only too well, it will be hard to spend that kind of cash. In fact, without even touching bullion, here are a few suggestions for what you could do with that $100 billion if it was burning a hole in your pocket. Firstly, you could buy every single company that makes up the Philadelphia Gold Bucks Index. That would set you back a cool $69 billion. Then you could buy every share of GLD that was outstanding, and if you wanted to, take delivery of the gold. After all, it's definitely sitting there in the vault. That would cost you a further $23 billion. You'd still have enough left to buy all the GDX shares in existence, with enough left over still to scoop up all the GDXJ shares for good measure. The last $2.6 billion, you could just blow that on something frivolous. Or you could save up another $25 billion and buy every major gold producer in the world, and then you could make a few changes to the supply side of the equation. Whatever you chose to do, that kind of influx into the gold space would change everything dramatically. And that's just 0.3% of pension fund assets. We're not even mentioning hedge funds. What if the pension funds decided 1% was the right number now? Or 3%? Or God forbid 5%? 5% would be a little over $1.5 trillion, a sum that simply couldn't be absorbed into the gold market without major disruption. And by disruption, I mean significantly higher prices. Either way, people would care. What we have is actually a simple problem. It's one of supply and demand, though it's complicated by a paper market which, with high leverage, prevents true price discovery, for now at least. Now, as you can see here, demand is robust for physical gold, with technology and central banks being the outliers. And it's worth pointing out that central bank demand may be down, but it's down 3% from a record high, so that's slightly misleading. What isn't misleading, however, is the supply side of the equation, where we see a 1% increase year on year, and that, with prices remaining depressed, is not about to leap in 2016, trust me. Demand and supply are in a dangerously tight equilibrium. It's dangerous because the demand side is certainly not about to decline at lower prices, quite the reverse in fact, whereas supply is going to struggle to increase by much more than a couple of percent unless we see prices back above $1,300, and even then it's not guaranteed. The strain on the supply is evident in the COMEX warehouses, where registered stocks of gold available for delivery have fallen precipitously since 2006. And from 6 million ounces just 9 years ago, we find ourselves today sitting on just 152,000. Now, the brilliant, and I have to say utterly charming, John Hathaway of Tocqueville recently published a paper which showed the dire straits in which the existing Western gold infrastructure finds itself. And when I spoke with John in New York recently, he was extremely animated about what he discovered. Now, for those of you lucky enough to know John animated means something. Now, previously, when strapped for deliverable gold, the COMEX has turned to the LBMA vaults in London. But, as you can see from this chart, outside the Bank of England vaults, the amount of gold available to plug any shortfalls in deliverable bullion is negligible. In fact, it's halved in the last year, which means the day that this becomes a very real problem is drawing ever closer. The amount of leverage in the gold market dwarfs that which we saw on the investment bank's balance sheet before Lehman collapsed. For every ounce of physical bullion in the COMEX warehouse, there are now 280 outstanding paper claims. To put that in perspective, Lehman was levered 33-1 when it hit the wall. Why is this not a problem? Simple. Nobody cares. The new daily physical supply coming onto the market is currently roughly about 10.5 tonnes against a daily traded paper mountain of 3,248 tonnes. Represented a different way, the chart is eerily familiar, as you can see. But with the steadily increasing level of physical deliveries into strong hands through the Shanghai Gold Exchange and the increasing demand for bullion from central banks, the day is fast approaching when everybody is going to care about the gold price. And that loneliness and confusion that many people here have been feeling for the last few years is just going to go away, I promise you. I'll leave you with my answer to that question I mentioned at the beginning of this presentation. With regards to the bottom being put in, like kids in the back of a car, the cry of, "Are we there yet?" rings out wherever I go and whenever I speak about gold anywhere around the world. And my answer is always the same: not yet. And to be honest, I don't know when we will be. I think we're close, but I don't know for sure. None of us do. But think of it like this. Gold is what I call an unsurance policy. The degree to which you're unsure about the world avoiding a repeat of 2008 or worse should be the degree to which you own gold. If you are absolutely certain that we're going to sail through the storm and that central banks are in complete control and won't let anything bad happen, then there's absolutely no reason why you would want to own any gold. If, however, you think there is, say, a 5% chance of a major dislocation, then 5% of your assets in gold would be a sensible precaution to take. Put another way, I think everybody here understands the concept of homeowners insurance. Take flood insurance, for example. Now, anybody who lives in Hurricane Alley in the southern United States happily pays flood insurance away every year and is delighted if they don't claim on it. They just want it there on the off chance that they may need it. Those premiums go up every year. Now, imagine if I offered you a flood insurance policy that was perpetual. You'd pay a one-off upfront cost, but that policy never expired, and it had a cash-in value on any day of the year at any hour of the day should you decide you no longer needed it. Your annual premium would fluctuate. Some years you'd pay an additional sum to maintain your insurance, but often that premium would be negative and come in the form of a rebate to you. But if financial disaster struck, this premium had a history of paying out every single time there was any stress. Surely you'd think about it. It's just baffling to me why these qualities in gold are so unrecognizable to most people. You see, that's the thing about hurricanes. You can go long periods of time without any major storms, 10, 15, 18, even nearly 50 years. But then, just when you wonder why the hell you write those damn checks to Geico every year, your roof gets blown off. And sometimes, just sometimes, there's another one right behind it. And often when the really big ones hit, they hit in bunches. And the best you can hope for, the absolute best, is to be one of the lucky ones whose insurance policy defrays some of the financial damage. It's far better to care enough to take out an insurance policy than to not care and be caught unprepared by an unexpectedly violent storm that seemingly comes out of nowhere. Right now, even though to those of us who pay attention to the gold market, things seem to be disturbingly out of sync and the iniquity of it all is quite jarring, the reason is simple. Outside of us, nobody cares. But the day is coming when that's going to change dramatically, and when that day arrives, the pendulum is going to swing to the other extreme, and that's a move which cannot be resolved without vastly higher prices. Until then, though, we wait. You've been extremely gracious with your time, and my sincere thanks for listening.
I'm gonna love you like no one's loved you, come rain or come shine. High as a mountain, deep as a river, come rain or come shine.